What does it mean for you?
Well,
today's news.
It's fantastic news. It's, as you know, we've been looking for a partner to grow with.
Yeah.
This is not a cost-cutting story. It never was. This has always been trying to find somebody with whom we share values and with whom we have no overlap. They're hard to find. And Federated, who bought the 60% stake in us as of the last night, closed the business in New York, have a complete complementarity with us. They're big in the United States. They're a large US asset manager. They're not big outside the United States, but they have fantastic. We are big outside the United States. We have no presence in the United States. There's no overlap in product or hardly any overlap in product. But most crucially, our values are the same. And by the way, we've been talking to each other since 2012.
Have you? Were there other options?
There were lots
other
of
potential partners?
Yes, there were.
Yes.
So mid last year, we launched a formal process. Why? We've reached a stage where our growth meant that the structure of being 100% owned by the BT pension scheme had to be thought through. Why? When I joined Hermes in 2009, something like 5 to 10% of income was from third-party, true third-party business. Year just ended, 70% is from third-party. So it's time for us to grow, and BTPS was supportive. We launched a process in August. There were lots of interested parties, and at least 3 or 4 we were interested in too, but Federated won through that as well. So they're the best offer that won in an open competition.
And the BT pension scheme still has a minority stake. Could they offload that in years to come?
So the BT pension scheme has a 29.5% stake left over. Federated has 60% stake. The management will have 10.5% stake. After a few years, there is a put-call option. It doesn't mean that the BT pension scheme will offload, but it gives optionality because it's a fiduciary, and fiduciaries have to have optionalities.
How will the business change? How will it be expanded? I know you've been looking to expand the business. What does it mean on that front?
So what's really exciting about this deal is we found a partner who's buying us as a going business. So we remain Hermes. There are no cost cuttings. There are no redundancies. What we think we can do is simplistically this. We can take our products and use their incredibly impressive distribution capability in the United States. By the way, we can distribute some of their products through our distribution capability, which, if I may say so, is also equally impressive in Europe. Secondly, we have shown to the market that by integrating ESG, the alpha is much better. We're very good at this. So we can take that and help them implement that with their strategies. And then finally, our stewardship business is coming of age. Now, the United States has been behind a bit, but we've seen with comments, not least from Mr. Bloomberg himself, but also from other firms such as BlackRock and so on, this is a growing trend. And we invented stewardship in Hermes, I'd argue, and we can take that to a new client base in America. So it's very exciting. This is a growth story.
And on the subject of strategies, which strategies, Saka, are proving successful and popular right now? You've got 16 differentiated strategies in equities, credit, private markets, real estate, infrastructure, and private equity. What's popular right now? What's successful?
So really interesting looking back at 17, as I've just done. The two most wanted strategies were emerging markets in Asia, but equally behind was private equity and infrastructure, was European equity, was credit, which still remains in vogue. So we're quite widespread. What we find is that with the move towards indexation, which is a general trend, there is a demand for high skill, high active share, true alpha strategies. That's what we've got. It's not index plus one, it's index plus a lot more than one. And that is the differentiator. And so we are beneficiaries of this trend of bifurcation of the market into index funds on the one hand, and then very high alpha on the other hand. And then the middle bit, which is coming under pressure, as you can see in the marketplace, we don't play in that field. We play in the other field, and that's why the clients like us. Plus, of course, look, we integrate ESG. So you have an excellent IR, you have excellent returns, and you feel good about yourself because you invest in somebody who integrates stewardship and ESG. What's there to lose?